In today's class, we are going to be talking about fix and flip and buy and hold. The debate between fix and flip versus buy and hold real estate investment strategies is a common one in the real estate community, and both approaches have their advantages and disadvantages. Let's explore each strategy in more detail. Fix and flip. Advantages. 1. Quick profits. Fix and flip investors aim to purchase distressed properties, renovate them quickly, and sell them for a profit. If executed correctly, this strategy can result in relatively fast returns on investment. 2. Active income. Fix and flip investors often see their profits as more of an active income stream, as they are actively involved in finding, renovating, and selling properties. 3. Lower long-term risk. Since the investment horizon is shorter, fix and flip investors are generally less exposed to long-term market fluctuations. 4. Creative expression. Renovating properties allows for creativity and personalization, which can be appealing to some investors. Disadvantages. 1. High transaction costs. Fix and flip projects involve transaction costs such as closing costs, renovation expenses, and real estate agent commissions, which can eat into profits. 2. Market volatility. The success of fix and flip projects can be highly dependent on market conditions, and a downturn in the market can significantly impact profitability. 3. Time-intensive. Finding suitable properties, managing renovations, and selling can be time-consuming and require significant hands-on involvement. 4. Risks of overestimating renovation costs. Underestimating renovation costs or encountering unexpected issues during renovation can eat into profits or even lead to losses. Hold on. Before discussing buy and hold, hit the subscribe button for more content like this. Now, let's proceed. Buy and hold. Advantages. 1. Steady cash flow. Buy and hold investors aim to generate passive income through rental properties, providing a steady stream of cash flow over the long term. 2. Long-term appreciation. Real estate historically tends to appreciate over time, so buy and hold investors can benefit from long-term capital appreciation. 3. Tax benefits. Investors can take advantage of tax benefits such as depreciation, mortgage interest deductions, and capital gains tax advantages. 4. Less hands-on. Once the property is rented out, buy and hold investors generally have less day-to-day involvement compared to fix and flip investors. Disadvantages. 1. Liquidity concerns. Real estate investments are less liquid compared to other investments, as it may take time to sell a property if needed. 2. Tenant issues. Dealing with tenants, vacancies, and property management can be challenging and require time and resources. 3. Market risk. Buy and hold investors are exposed to market fluctuations, and a downturn in the market could impact property values and rental income. 4. Financing challenges. Financing a buy and hold property may require a larger down payment and securing a mortgage, which can be more challenging for some investors. Ultimately, the choice between fix and flip and buy and hold depends on individual preferences, risk tolerance, financial goals, and market conditions. Some investors may prefer the potential for quick profits and active involvement of fix and flip, while others may favor the stability and passive income of buy and hold investing. Additionally, some investors may choose to incorporate elements of both strategies into their real estate investment portfolio for diversification. Brickfront Properties and Construction hope you have learned and can decide which best suits you. For more tips, like, share, and subscribe. Till next time.